Just like imagine you're a customer. You're showing up at the financial planner's office. What do you see? So you're picking, hey, I'm comfortable with a 50. Let's use me as an example. I'm young. I'm willing to risk it. Let's use your $1 million for an example. So what I'm saying to the financial advisor is I'm comfortable losing 25% of whatever my portfolio without having to, repurchase or refit. Is that kind of what it is? But then also you're showing the upside of, well, look, risk reward is obviously a thing everyone knows. What maybe walk me through kind of what my experience would be.
Yeah, so your experience would be coming into speak with your advisor, and your advisor would say, "Hey, let's have a conversation about how much risk you're willing to take and how much return you can expect to earn over decades um, if you take that amount of risk." And so he'd start the conversation. If your $1 million went down to $900,000, would you be able to hold on? Would you be able to stay the course? And then you'd say, yeah, I'm young. I can handle that. So then he'd increase the slider to 20%. Say, can you handle 20%? Can you handle your account going down to $800,000? And then he'd continue that conversation discussing implications with you of losing money until you say, no, 35%, that's all I can risk. And then the asset allocation recommendations will be will be the out will be the like intermediate output. So you and your advisor can select either the traditional stock bond or the hybrid allocation, which is the stocks and annuity. And then the important thing is that that selection feeds into an investment policy statement that the advisor can then print and sign with the client. And in addition, a key component, and this is really an example of how this sounds simple, but it's a very important step, is that within the investment policy statement is what we call the risk pledge. So the investor is actually promising, the calm current investor is promising to their future frantic self when the markets are going crazy that, hey, I'm not going to capitulate unless the promise my investor made me about how much risk I'm taking in this portfolio, unless that promise is violated, I'm not going to break my own promise to myself. I'm not going to break my risk pledge. So that really gets the investor to like psychologically own the process because they're involved in this conversation, and then psychologically own the result of this process because they're promising themselves to basically not shoot themselves in the foot. And our expectation is this is going to, one, reduce the turnover that we saw at our last company, but also I really think it's going to dramatically improve clients' returns because they'll hold on when they should rather than selling, which people the Dalbar studies have shown time and time again that the average investor costs themselves around 3% a year through bad market timing.
Yeah.
Rob, we kind of all know that risk assessment and aligning expectations with reality is critically important to investor success. Obviously, there's a lot of different ways that financial advisors measure risk that a client's willing to take or a prospect's willing to take. Can you talk about some of the others and talk about the implication of being wrong in this decision-making process?
Okay, so the three most popular risk assessment systems are now Riskalyze, which I've already discussed. Then the second leader in the market, who has about 5% market share, is known as Finametrica. And I also did an analysis of their output. Pardon me. And what I found is that Finametrica risk tolerance questionnaire takers, based on Finametrica's assumption that risk tolerances are normally distributed, they bunch way too many investors, according to my experience, close to the 50-50 portfolio that they consider moderate. Actually, it's close a 45% what they call growth assets. But 86% of investors are assigned a amount of growth asset between, I believe it's 21% growth asset and 21% growth asset and 70% growth asset. 86% of investors are in that, kind of narrow range. Only 1% of investors are recommended a portfolio with over 84% growth assets. Well, given that, probably 50% of investors are below 50 years old, it seems like all of those people have, since they're not going to spend their money within the next 15 years, all of those have the capacity, what's known as the risk capacity. They could have a 100% equity portfolio if they could psychologically handle the risk. And so it seems to me that many more than 1% of people should have more than an 84% in growth assets, or by growth assets they mean the stock market.
Yeah, they do something equally as I'm not going to say silly, but I guess I just did. On the downside too, right? On the more conservative side of the asset allocation.
Yeah, they say that only 1% of investors should have less than 10% in non-growth assets. So non-growth assets in their world, as I understand it, would be fixed income. But lots of people in their 80s or 90s, they might say, I know I only have 10 years to live. I don't have kids that I care, like I'm not trying to grow how much I'm giving them. I'd just rather just not worry about the turbulence in the stock market. And they only give 1%, that opportunity. And that just seems unlikely to me as well.